Back in March, I created a 64 stock bracket that I called Dividend Madness. And the idea was in the month of March, I would go through all 64 stocks, pick a winner in each game based on different criteria, and ultimately choose the best dividend stock out of the 64. Well, it's currently August, so I'm a little bit behind on my March deadline, but we're finally here at the final four.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
When it comes to being a successful investor, most people think it comes down to having a high IQ or maybe having a really high income so you can save a lot. But if you look at past investors who have been able to accumulate massive amounts of wealth, ranging from people like Ronald Read, who had very little income as a janitor, to people like Warren Buffett, being one of the richest people on earth, most of their wealth building really comes down to their mindset. The way they think about businesses, the way they think about money in general is absolutely critical to them having built the wealth that they did. It's also critical to you building wealth. So I built an 8-day mini course calling the Financial Freedom Mindset. I'll put a link in the description below if you want to sign up for that. It's absolutely free, and every day I'll send you one video that talks about a specific mindset that some of the most elite wealth builders share. And now back to the video. So if you haven't seen this series so far, the Dividend Madness 64 team bracket was ranked by the top 64 companies by market cap that had at least 25 plus years of dividend growth, i.e. the Dividend Aristocrats. So these 64 companies made up the bracket. So here they were. Each team was seeded based upon market caps. But you can see the winners each and every round. We did them based upon different metrics. So in the first round, we looked at metrics that suggested a company had a competitive advantage. In the next round, we looked at some valuation metrics. And in the last round, we looked at some dividend-specific metrics. And in today's video, I've combined all of these into one. In the first matchup, we're going to look at SherwinWilliams versus ADP. So we have 10 different metrics spread out across 4 different charts. In this first chart, we've got earnings per share excluding extraordinary items over the last 12 months. Then we've also got the 3-year average free cash flow per share. And here what we're looking for really is consistency. So we want to see businesses that are consistently growing both cash flows and earnings. And while both of these are pretty consistent, it's pretty clear that this chart on the right are both increasing at a nearly annual clip for ADP. So this one definitely takes the victory there. In the second chart, we're looking at the 5-year free cash flow divided by capital employed, and capital employed is very similar to invested capital. It just takes long-term debt and adds the equity of the business and then subtracts any cash or cash equivalents. So for every dollar that this business reinvests back into itself, what return does it get on that? And then we also have the standard return on invested capital metric using earnings before interest and taxes divided by invested capital, which is only long-term debt and equity. And here it is, again, a very clear victory for ADP. You see both metrics are over 45%, which is absolutely amazing. So a blowout victory there for ADP. This next couple charts, we have sales growth. We're looking at the 5-year compound annual growth rate, the 5-year compound growth rate for earnings, and the 5-year compound growth rate for dividends. And if you look at dividend growth, Sherwin-Williams is superior at 16.2% compared with ADP at a still impressive, but certainly lower 13%. We also see that it's superior in terms of sales growth. So Sherwin-Williams growing at 8%, whereas ADP growing at 6%. At the other end, we have earnings at 4.4%, whereas ADP is at 13%. So it's a bit of a mixed bag, but if you just take a look at the average or median, either one, you see again, ADP is victorious. The median would be 13%, whereas the median for Sherwin-Williams would be 8%. So this is a close one, but I think the victory again goes to ADP. And then finally, we have a valuation chart. Here I've converted everything to yield, so it's a little easier to see. Ideally, you want to see a higher yield, not a lower one. So first we have the operating income 3-year average yield, and I'm dividing these by enterprise value, which is, in my opinion, a little bit better of a metric than just simply taking the market cap, because this also includes debt. So a business that has a very high EBIT to market cap ratio may be kind of masking some things with a super high debt load. So this enterprise value rewards companies who have high cash and low debt, and it penalizes companies that have high debt, low cash. And we also have free cash flow yield, 3-year average divided by enterprise value, and then shareholder yield, which simply combines the buybacks plus the dividends that are being paid. I think this is a more comprehensive metric than just dividend yield alone. So higher being better, we see that ADP has the higher EBIT to EV ratio at 3.65. It also has the higher shareholder yield at 3.35, and then very close between free cash flow yields, 2.7 versus 3. But again, I think ADP takes the victory here. So for those of you who've been following the entire series, it's probably no surprise that I am a big fan of ADP. It's scored very well in every round so far, and it is moving on to the final 2 stocks. Next, we have a very interesting matchup between Lowe's and McDonald's. So in the first few charts, we're looking for consistent increases in earnings and cash flow, and really with the exception of maybe 1 year here in 2019, and then a little hiccup back in 2022 at the end of the COVID stimulus bubble, essentially. For cash flows, Lowe's has had an extremely consistent increase in really earnings and free cash flow, but particularly free cash flow. If you look at the green line, it really only declined one single time back in the recession of 2020 related to COVID, whereas McDonald's has also been pretty consistent, but certainly a lot more inconsistencies, particularly when it comes to earnings. So Lowe's will take the victory here. We're looking at competitive advantage. Again, the advantage goes to Lowe's. Not only are the numbers basically twice as high as McDonald's, but they've been increasing over time, whereas you see McDonald's has basically been flat to slightly down. Still very impressive scores at 14% and 18%. The average company is probably looking at somewhere around 10%, but Lowe's is just extremely strong and increasing, 28 and 34, an easy win for Lowe's. Another easy win here for growth. The sales, earnings, and dividend growth have all been superior for Lowe's, with the median at about 20%, whereas the median for McDonald's would be here at 5.5. So again, victory to Lowe's. Surprisingly, a clean sweep for Lowe's. Every single metric that we've seen has been better for Lowe's, including the valuation scores. So we have the 3-year average EBIT to EV. That is at 6.9% versus 3.5%. The shareholder yield is a staggering 10.8%. Just note that started to come down as they've cooled off some of their buybacks. Compared to McDonald's at a relatively impressive 3.3%, still pales in comparison to Lowe's. And then also the free cash flow yield is more than double for Lowe's relative to McDonald's. So the final 4 is now down to 2 stocks. So will ADP or Lowe's bring home the championship? Let me know in the comment section which ones you think. A reminder, if you want to sign up for the 8-day mini course on financial freedom mindset, that link will be in the description down below. So thanks for watching, and I will see you in the next video.